Yer, what's good, family? So, first off, I'm gonna love this topic. Second of all, thanks for tuning in. My name is Nelly, and we are here again for another podcast episode for the psychology section. And basically, this is gonna be a very interesting topic, which is risk management. Woo, yeah. This is gonna be lovely. Risk management. I promise I'm not on anything. Anyway, we'll keep it moving. Risk management, right? So, we're gonna dive right in. Risk management. Risk management. The importance of risk management in trading is that it's very important. That's it. It's the make or break of your trading. That's it, right? So, in trading, you have three things that you really have to be great at. Really great at, right? Number one is going to be technicals, right? Now, this isn't in no order, but this is basically like how you learn, right? Number one is your technicals. You got to make sure that you're good with, drawing on the charts, marking up charts, being able to predict where the market can potentially go to, right? I'm not the type that'll be like, oh yeah, the market will go here. Or, no, I always use should or can, things like that, because I'm no guru. I'm not portraying to be a guru. I just know how to chart. I know how to mark up. I know how to do my thing. That's it. Simple. Second is risk management. That's a very important thing, right? Risk management is basically the power, right? The power that we have to basically preserve our capital, protect our capital, use our capital correctly, properly to practice proper risk management. Okay, and the third one, obviously, is the most difficult to achieve, psychology, right? This is the reason I'm making this section, because I want to put the psychology into all of these factors that are in trading, right? So, with that being said, psychology really dives into risk management, because if you're not being able to have a stable mind, especially during the losing streaks of when you're trading, you need to be able to dive in and use that proper risk management to save your account. Because if you're not in the right headspace and you're down a few bucks or whatever, and you're saying, you know what, I'm gonna risk it for the biscuit and make me a brisket and go ahead and just sell everything or buy everything in the markets and then just lose the account, you're gonna put yourself in a bad predicament, possibly. And I say possibly because you can get lucky, but it won't be sustainable. So, with that being said, the importance of risk management is very important, because risk management is what helps you stay alive in the game, stay alive to trade another day or another week, and then continuously be able to put yourself at an advantage against like a bad week or a bad few days. It happens. Understand that you're gonna have bad days, you're gonna have possibly bad weeks, even a bad month, or even a bad quarter. So here's a news flash for anyone who says risk management doesn't help, okay? Here it is. When you are in a drought and you're going through drawdown for several periods, right? Whether you think it's a few days, a few weeks, a few months, and by few months, I mean a quarter, and you start to say, man, I've been trading this strategy for 3 months, a whole quarter, and it's trash. I don't ever want to do this again. Throw away the whole strategy and start a new one. Do you think that those big companies that are trading millions and billions of dollars, you think that they throw away their strategy just off the rip? Just for giggles? No. You think that they don't have red months or red quarters? They do. Some of them even have red years. For example, some people nowadays, they love to trade NASDAQ. NAS 100. Guess what? The NAS sometimes has a red year. It happens. It happens. You're going to be a trader one time where you're going to have so the whole purpose is to be a profitable trader, right? You don't want to have a red year, but maybe, a red month here, red quarter here. But then at the end of the year, long term, right? Long term is to have green profitability overall 12 months. What do you think you need to have those green months or green year? Risk management. Preserve your capital. If you're just throwing money in the market and expecting to get rich overnight, and you hit a bad streak, you're not going to have an account to be green in anymore. You're not. So that's the importance of risk management. Risk management is basically you calculating your risk to use and then being able to understand what you're risking per your trades, per your account, things like that. Now, risk management has a very, there's different ways to risk, right? I go over this in my course, so I won't spill beans here. But here's what I'll say. When you learn how to capitalize on the risk management, you automatically open yourself up to being able to build accounts. Doesn't matter if it's prop firm or whatever, but build accounts to where you can be like more sustainable in keeping those funds with the risk management. Because now, like, even though you go through a little drought and you're going through a little rep period, you can automatically put yourself at an advantage to be able to throw the psychology part in there to say, you know what, I'm going through a little drought right now. I'm a little red, but Nell said I need to follow my plan. I'm going to follow my plan. I'm going to trust my analysis. I'm going to trust myself, and I'm going to go ahead and just stick through it to the end until I start getting profitable again. And as long as my risk management is intact, my risk to reward is intact, my strategy is being followed to the T, I'm going to make it. That's it. I'm going to make it. Simple. So the importance of risk management is very, very important, because that's the thing that basically keeps you alive day in and day out, week in, week out, month in, month out, quarter in, quarter out, and year out. Like, that's it, all every single day. That's the importance of the risk management, and you need that. You need that. So with the risk management, a few things tie into it, right? You need to learn how to position size. Position size means if you have like $1,000 and you're risking, let's say, you're risking about 1%, right? Then, you know, you're I mean, that, I don't know what you would be risking. This is going to be controversial, but I'm going to say it. If you have $1,000 and you're really trying to make money, you shouldn't really be risking 1%. Okay? You shouldn't be risking 1%. And this is no financial advice or anything like that, but I'm saying it in the times that we live in. You can't be scared to listen. Scared money make no money. And I'm being raw. You got to be able to risk in order to get the reward. If you're not risking much, then you're not really making anything. Again, $1,000 and you're doing, $1,000 and you're risking 1%, you're risking $10. That's it. So let's say that your risk reward is a 1 to 2, right? Meaning a 1 to 2 risk reward, meaning you're risking $10 to make 20. All right. So that means that you risk $10 and then you make you win, you make $20. Now, I get it. $20 could be some gas, it could be a haircut, it could be maybe some nails or something for the ladies. I'm not sure how much that's going for right now. But it could be maybe, a meal, right? Maybe a meal for the day or something like that, right? Because groceries are going up, so I don't know if that's even going to cover groceries. Maybe in the 90s. Anyway, I'm an 80s baby, so you already know. Anyway, so when you are factoring the risk management, you want to be able to be consistent with the risk management, right? But you got to understand how your strategy works. You got to understand what's the expectancy of your trading data, right? Like how much your strategy wins, how much it loses, things like that. And then you'll be able to factor in the risk to reward based off your strategy expectancy. So then you can go ahead and say, okay, cool, boom. Because my strategy used this, I can go ahead and risk that. I should be good between the drought. I should be able to come back and win all the losses I've occurred. That's it. I've acquired. That's it. Now you be good. Now you're set. You straight. You Gucci, as I always like to say. You Gucci. All you gotta do is put yourself in the mentality and the psychology to say, okay, if I lose and I start losing, I can do two things. I can suffer through that pain and continuously risk what I'm risking, or I can dumb down my risk as I'm trading during that drought where things are not looking good, and I can go ahead and risk. So for example, again, now, right, you're risking 1% of 1,000, you're risking $10, right? Now nobody wants to risk less than the 1%. So let's just bump it up a bit, and let's say you're risking 10%, right? Let's just keep it easy math. 10% of $1,000, you're risking $100. But let's say that you're going through a drought. Maybe you want to dumb the risk down now to, like, let's say $50. $50 instead of like the $400. Now you're risking $50 during the drought. So that right there, you start to automate. Now you're risking 5% instead of 10. now you're automatically like putting yourself in a position to be able to be mentally stable to say, okay, because I'm going through a drought, I'm gonna cut my risk and I'm gonna go ahead and trade this with a 5% until my winners start coming in. Once my winners start coming in, I'm good. Again, keep in mind, you went from 10 to 5. So even if you were to win 2 trades in a row at a 5%, you're making 10. That means you still got one full percentage back. So you're okay with that. You gotta understand it's levels to it. You gotta like stick it through. Simple as that. You gotta stick it through. Now, position sizing happens in different ways, okay? So, and by different ways, I mean like a lot of people, they do the position sizing differently and and it gets really, really like complicated with the position sizing. Your currency that you're trading will not always be a 1-to-1, okay? So like dollar pairs are usually 1-to-1. AU, Euro, things like that, right? You're not gonna get the same 1-to-1. And by 1-to-1, I mean like if you have a 10 pip stop loss and then a 20 pip reward, right? And then you go and let's just say that when you hit TP on a 1-to-1 ratio, if you end up making that $100, you might get the $100, of course, subtracting fees and commissions and whatnots, but you make that $100 on that euro-based pair. But on a pair like GA or whatever, right? Pound Aussie, you're not gonna get that whole, 69, you're not going to get the whole 100. You probably get like $69 to $89 or something like that, $90 or something like that, because the value of the currency exchange is different. So you got to do due diligence on that. I'm not going to confuse you. Just go ahead and probably already did. But there's a lot of terminology in it. You got to do the research. Again, babypips.com does a great explanation on those, right? And there's also YouTube University where you can go ahead and like just dive into that, right? But aside from that, stop loss usage, right? Oh, for the position sizing, for those who keep asking me like, how do I get my lot size? You can do a few things. One, go into my description and you can go ahead and get the Magic Keys calculator, right? You can get either the physical form or the digital. I like the digital. I just put it on the screen and boom, it does everything for me. I'm chilling, I'm good. Or you can just like, I don't recommend doing the calculator, so I'll just leave the Magic Keys on it right there, and I'll just leave it at that because that's like the easiest way, and it really, really helps. So I'll link the Magic Keys calculator down below, and you can just like grab that, and that's it. It's like at the time when I bought it, it was like $30 one-time payment, and it was like it was slamming. Like that's it. You know what I'm saying? But yeah. Now, another controversial topic is stop losses. For your risk management, you should be using a stop loss. If anyone tells you not to use a stop loss, it's gonna cause trouble for you, okay? Because you're not gonna understand like what they're doing unless you know their strategy in and out, right? In and out. Now, stop losses preserve your capital. Stop losses protect your capital. I don't care what any trader says. Like I'm guaranteeing you, like if they don't use the stop loss, right, and then they're not paying attention to news, and then it just drops or flies, or depending on if they're selling or buying. If it drops, right, let's say they're buying and it drops, they're gonna be pissed off because now instead of them losing, whatever, like 10 pips of a stop loss or 20 pips of stop loss, 30 pips of stop loss, whatever the case is, now because of the big drop of whatever the economic news was, now they're down like a 50 point deficit. About 500 point deficit because obviously it goes through points, but pips, 50 pips deficit. And now they're like, oh man, I lost half of my things and whatever the case is. Now I'm pissed. You want to be careful. You want to be sure that you're careful with that. You know what I'm saying? Just had a call come in. Hopefully that didn't bother. Let me know if y'all with me. Anyway, so stop loss orders, you need to use your stop loss. Please, please, please use your stop loss. There's no point of back testing, so you can utilize and test where your stop losses should go. Once you get your stop losses, you're good, you're Gucci. You ain't got to worry about nothing. All right, diversification and risk to reward ratios. I'm gonna tell y'all right now, if you are not diversifying yourself with your risk management, and this was the part where I was saying about the 5%, 10% thing, you gotta like put yourself in that position to diversify when you're winning and when you're losing, and be able to maximize on your winners and dumb down on the losing, so you're not risking more your capital and you preserve your capital much more better. Now, risk to reward ratios. This is where your risk management heightened, right? This is where like you start to get those gains coming in better, right? I'm gonna speed this up because I know I'm already past the 10-minute mark. I want to make this short and sweet, but again, this is a great subject to be on. So, risk to reward, man. Risk to reward. You shouldn't have a risk to reward less than 1 to 2, unless you're scalping. If you're doing the scalping, you do the 1-to-1. I get it. It's cool. If it works for you, do it. That's okay. I'm not knocking anybody who's using 1-to-1s. That's totally fine. I get you. Do your thing. I respect it. I'm saying like if you're struggling and you really want to like take like the punch towards like the consistency first, go ahead and dabble, and especially psychology part. You want to dabble into the 1 to 2. The 1 to 2 or more is gonna be like really put you in. For me personally, I'm at a 1 to 3. Or more. I use a 1 to 3, 1 to 4, 1 to 5, and I do that, and it's a better trading ratio for me. That's it. So risk to reward basically means that whatever you're risking, it's either gonna be 2 to 3 times all of that. You know what I'm saying? So let's say if I'm risking like 10 pips, I want to make 20 pips, or 30 pips, things like that. If I'm using a 1 to 2 or 1 to 3, right? Now you can use pips or you can use percentages, right? You can say, okay, well, I want to risk 1%, right? And then I want to make 2% or 3%. That's another way to use the risk management in the percentage-based scenario. So utilize what works best for you. I don't like to look at the monetary value, but you can put it like in a more easy fashion in that manner. Okay, I'm gonna risk $10 to make $20 or $30. That's what you want to go ahead and do. You know what I'm saying? Now, with that being said, you want to build, and this is the next. I'll end with this. It popped in my head. You want to end your plan, right? Not end. I say end because like first, like in a trading plan, you should have like your setup and things like that. And then, but with your trading plan, you want to make sure that you have strategies for protecting your capital. You want to make sure that you have strategies where like if this happens, boom, I get out. Or this happens, I stay in. Whatever the case, you want to have risk management strategies that automatically like help your trading plan excel and help you as a trader excel. Not your trading plan, but your trading plan is your guide. You need your guide. You need to follow that to the T and just do your thing. So with that being said, again, and y'all listen, man, I usually don't do this, but I do offer services to help you build a trading plan from beginning to end and give you everything that you need for it. The only thing that I need from your end is basically like what kind of style of trader are you, like what your plan consists of, and then building something around that to where it helps you. That's it. But that's a one-on-one type of thing between you and I. That's it. Now, strategies for risk management is very, very key. Do not leave that out. That right there, it will be a very pinnacle stepping stone to your consistency to becoming a profitable trader. Okay. With that being said, much love. Y'all have a great one. Deuces. God bless. And I'm going to catch you on the next one. Peace. Oh, again, thank y'all for the comments. Thank y'all for the likes. Thank y'all for the love. This has been like a crazy few weeks. And it's been nothing but love. I appreciate each and every one of y'all. Please continue to like. Please continue to subscribe. I am loving the engagement. And again, notification bell. Click it. Tap it. Get tapped in. I'm dropping gems that, yo, like, I usually charge for this. And I'm dropping it for like free. You know what I mean? Like, I want y'all to excel. I want to be able to give y'all everything that a lot of traders like gatekeep. You know what I'm saying? So, again, do not hesitate to like ask questions. My handles are in the description if you want to hit me up. I can put my Telegram, my IG on there too. Like, I'll be on IG and everything, so hit me up. All right. So with that being said, I want to try to keep this under 20 minutes. And then yeah, if you have any questions, any suggestions, what do you do? What is your risk management consist of? Are you percentage based? Are you money based? Are you pip based? What's your risk management based off? All right. Y'all have a good one. God bless. Peace.